Here's why index investing is not the right option for most retail investors. This isn't going to go over well. So let's start out with the facts. Facts, not opinions. The average investor's returns suck. Here's a stat that's published by JPMorgan every single quarter. The S&P has averaged and annualized 7.5% per year. Bonds have averaged 4.8% per year, yet the average investor has returned just 2.9% per year. As you can see, almost every other asset class outperforms that. How do you get numbers so low? Mathematically, there's only one way to get there, and that's buying at the wrong time, the highs, and selling at the wrong time, the lows. Why do people do that? Because they are simply taking too much risk. Okay, now what is an index fund? 99% of social media that talks about index investing is speaking about stock index funds, aka 100% stocks, 100% in the riskiest asset class. Social media may tell the average person to stay the course or buy the dip during tough times. But what does history tell us? Is the average investor able to do that? Well, let's look no further than last month, April. The S&P 500 is down 8.8%. Fund flows were negative $52 billion, meaning there was $52 billion more sold out of the market than there was buying of funds. This is called selling at the wrong time. Last piece of evidence that people shouldn't have 100% stock exposure, regardless of how risk tolerant they are or their forever time frame that everyone claims to have. Take a look at Harvard's Endowment Fund. To be clear, this is $53 billion of capital that could take on all the risk in the world. But they don't own 100% stocks. Yes, there is a nice slug of stocks in this portfolio, referred to as equities in the image, but look at that exposure to bonds, commodities, and real estate as well. Summing it up here, investing in index funds, which are 100% stocks, probably isn't the right thing to do for the average investor, or any investor for that matter. Harvard. It's simply taking on too much risk and is not a responsible approach. The average investor is not dumb. Our brains are simply hardwired for survival, which means selling when it's scary. So instead, let's limit the scariness and downside and consider diversification: stocks, bonds, commodities, and real estate.